Good morning, oracles. Goodness gracious, yesterday was just as ugly as we thought it was going to be. We heard the news over the weekend that Putin wanted to invade, and so he did. And while it's, I guess, technically not an invasion, whatever, it's causing quite a ruckus. And we saw the gap down and the sell-off yesterday. Now, the bad thing about the gap down is, as we discussed, when you see a gap up or down, it usually fills. Well, I was anticipating a gap down and perhaps the stock staying lower, which would mean that we would potentially run up later. Well, the gap actually filled yesterday. There's technically like a 27-cent difference between the two. So it's, I guess, technically not filled by 27 cents, but it was pretty darn close. And we closed below the 200-day moving average. So that is a bad sign. With the tensions that are going on with Russia and Ukraine right now, seems like we're probably going to see, a bit of a sell-off still. The uncertainty about what's actually going to happen, how are we going to react to it, lots of different things up in the air about that. What I have heard, though, on the news is that this whole situation might actually offset the sell-off that we were anticipating in March. So if that's the case, similar to what happened in January, I assumed we were going to get a mid-February sell-off. That ended up happening in January. So whereas we thought that we might get a mid-March sell-off, we might actually get that now, which means that when March rolls around and the interest rates go up, we might not see the same sell-off that we were anticipating. And now if this is the case, this might actually bode well for the stock. Obviously long-term, we know it's going to do well. But in the short term, this might time out well with the opening of Austin and Berlin, because if we have the pullback now over the next 2 weeks, and then they announce the opening of Austin and or Berlin in the first or second week of March when we anticipated the pullback happening, this might actually play out well. This might actually be a positive catalyst during another run up after all of the hoopla that is going on over in Russia. So there's a good chance that this might actually play out well for us in the short term and kind of maybe get a short-term rally going. Any rally would be nice right now. I know the feelings a lot of us are having is just enough of the beatdown, enough. Like, I love buying the dip. I love buying it at these prices. And now I have cash to invest, but my goodness, it sure would be nice to see a bit of a rally going on. I've got plenty of money to invest. I've got money coming in from the outside. So this is still a great thing for me. And, I know that in a year from now, we're going to be looking back at this going, wow, I wish I could have invested even more. So I see it. But again, with the closing below the 200-day moving average, I looked back in the charts, and Sudip did a great job seeing the chart back in June. And I went back and I looked at the charts, and going back to May 19th, there's actually a gap that goes from 563 to 570. Now, granted, gaps fill 9 out of 10 times. So, we've seen every single gap that we have talked about get filled. There are a lot of gaps that I noticed over the last 8 months that have been filled. So, we have definitely hit that 9 out of 10. So this one may be that 1 out of 10 that does not fill. So this may be one that does not get filled, but it is still there. So I'm going to keep an eye on it. It is from a long time ago. We've gone through quite a few runs since then. So there's a good chance that it's not going to fill. However, we are in a very volatile market right now. There are still talks about potential recessions going on if oil gets over $100 a barrel. We have Russia-Ukraine still happening. China and Taiwan could potentially be an issue. Lots of different negative catalyst stuff going on in the market at the moment that we can foresee for the next 12 months. So not to say it's not going to happen. There's a strong chance that it's not. But hey, it's totally possible. I'm still going to continue to dollar cost average. Again, don't know where the stock's going to go from here now that we've closed below the 200-day moving average. We're starting to creep up after hours, so that is nice to see. So I think if we bounce up higher, we'll be fine. Looking at our wedge pattern, we have definitely broken down below it. If I extend it out, still technically could be in the wedge, but it's definitely broken down. So I'm going to say that we have broken that pattern. We have broken down out of it. as we had discussed what could have potentially happened from Russia-Ukraine. And so that's where we're at right now. So now we're going to try to find our footing again, see what's going on. Hopefully over the next 2 weeks, we can find a bottom, settle down, and then get some positive catalysts to start to move the stock back up again. And the other metric I look at is the RSI, and today we closed at around 36.95. So we're below 40, we're not at 30 where it's oversold yet, but we are definitely getting down there. So, we can see potentially the rest of this week could be volatile. We may have a couple of up days, a couple of down days. It is a short week of trading, so we will see what's going on. We know now that Russia is invading Ukraine, so we don't have any more uncertainty there as far as whether they're going to or not. So, it's just going to be the uncertainty of what is going to transpire from this invasion and what's going to happen because of it. And so going back to the long-term view, as most of us on here are long-term investors, this is still going to be a great time to buy. And our forward PE is extremely low at the moment. So if we go further down, it's just going to drop the PE even further. So everything that's going on right now in the macro environment is not going to change the fundamentals of Tesla still. They're still going to be producing their vehicles. They're still going to be selling their vehicles. They are still maxed out on demand. They cannot produce enough vehicles to meet that demand. So their numbers are still going to be there. So every single earnings that we get is just going to knock that PE ratio down even further. And so that just means that the stock is going to get cheaper and cheaper every single quarter we go through. And if you look at it as like PE compression and you're compressing a spring down, as we go through the quarters, the PE is going to be compressed further and further. And eventually we are going to come out of this downward negative cycle. We always do. It's just a matter of when. And the longer it takes, the more this spring is going to be compressed. So as soon as we come out of this, that spring is going to bounce back up and we're going to come out of this. Not to say it's going to be a sharp V-shaped recovery when we come out. It's not going to be a straight sky-high run, but it could be. And when we come out, we are going to come out even stronger because we are going to have such strong fundamentals with such a low PE ratio behind it that we're going to come soaring out of this. Looking at volume was definitely higher today at 27 million shares traded. But there's still a lot of money sitting on the sidelines waiting to see what is going on. Now, with the stock coming down as low as it did today with high volume, that just means a lot of people are selling out. That just means that the support that we had is starting to erode. So we did see today extremely strong support around 800. So let's see if we can maintain that and bounce around it. If we can continue to use that as our support and we can go forward with that, that just means that we can build off of that. And if we break below 800, our next strong support is around 770. So we'll see what happens. Again, this is just a dollar cost average environment to be in right now. If you're a risky player out there, go ahead and take your chances with trading or with options. That's not my style. I know many of us on here are not that style either. So we're going to ride it long term and just dollar cost average. Be wise with your dollar cost averaging. I have adjusted my strategy already as we are in a more extended period of dipping as I expected. So I have adjusted mine. So I'm kind of like at $15 every 2% or so that we drop. And then I'm kind of holding. So I don't know if I'm going to be adding more until we drop below 800 or not. I have dropped below 4% of cash on hand, and I do want to continue to build that. I've been adding to other positions as well, so it's not like all of my money is going into Tesla, but I do want to make sure that I have enough cash on hand to keep on buying this dip as it's dipping. Let me know in the comments below, how far do you think Tesla is going to fall before we hit the bottom? And when we do hit the bottom, how long do you think it's going to take before we recover? Thank you all so much for watching. I appreciate all of your support and feedback. If you have not subscribed, please do so down below. Sign yourself up for notifications. I am over on Twitter at OracleTim1. I share all the latest Tesla news, pertinent stock market information, and all of my daily trades. Thank you so much. Have a great one.